before we start this conversation, we will have also a PowerPoint presentation. I would like to invite our guests to introduce themselves, and then we can start.
Good morning, Yori Marango. I am the biotechnology analyst at Roth Capital. It is emerging growth investment bank based out of Los Angeles and New York. My own background is originally on the academic side with a focus on oncology and inflammation, pure transcription, so very basic science. On the business side, on the Wall Street side, I've been with a number of investment banks and investment fund, and I've also helped start 2 companies. So I've tried to stay involved on all sides of the biotech life cycle. Thank you for having me here at BIOSPAIN.
Good morning. Good morning, everybody. My name is Claudia D'Augusta. I'm currently just announced that I've joined the IPOs as venture partner, and I'm also still acting and general manager for Italica, which is a company based here in Spain and recently acquired by Takeda, specialized in cell-based therapies. And that's my background, basically is finance. So I've been previously for more than 13 years CFO of Italica.
Thank you. My name is Susana de Antonio. I'm a director and Spain representative of Euronext for the Spanish market. I joined Euronext in May 2017, and before that my background was mainly in private equity, and my educational background is mainly finance.
Okay, so we are just going to start with some opening remarks, and I think that well, for every European biotech company, the U.S. market Nasdaq, well, we are going to have today the opportunity to listen about the beauties of Euronext as well, where we will have also the case study of Italica, which was doing the dual track. But as I said, I mean, the Nasdaq is always there in our imaginarium, and to some extent it represents what it could be the maximal capabilities for financing a growing project like a biotech is in most of the cases. So I think that it's clear to everybody that we are now seeing in a spectacular market. Yes, this week, this particular precise week, we have seen announcements to do 13 IPOs on Nasdaq, and 5 of them are on biotech. So yeah, I would like to invite Jotin, who represents here Wall Street, to give us some of the colors and to give us some details how the dynamics of the markets in the last 2-3 years, and particularly this year, and to what extent you can foresee for the coming months and what is going to be the dynamics.
Okay. So thank you for coming this morning. It's you know, I'm surprised. I was trying to think of the attendance here, and it's nice that we have a larger attendance here this morning than there was at the inauguration of the last U.S. president. So congratulations to us on that. And on that note, that will be the last political comment that I make. In the number of biotech companies, and all my comments going forward are going to be only focused on the U.S. market, and you know, I'll leave my colleagues to opine on the European biotechs. The number of biotech companies entering the market in the U.S. has grown. The number of companies that stay in the market also has grown, and so has M&A. The trend begins really slowly in 2012 or so, and then it accelerates fantastically after 2015, so in the last 3 years. So looking at the biotech IPOs that have happened, there are 2 trends that I thought it was appropriate to mention here today. One is the valuations. Seeing at the number of biotechs that have IPO'd, let's say in 2016, there was about high 20s, or almost 30 of them. And they are, you know, the valuations are up about 72% to date of that IPO class. Looking at the 2017 class, so last year there were about 10 more in the high 30s. Their valuations are up about 50%. And then the class from 2018 to date, which I think is 40 plus, these are just biotech. So it's certainly not linear. Their valuations are up 20%. Now, that sounds like a no-brainer for any crossover investor or investor to enter that IPO market. It does not seem as magical if you just compare it to the MBI index. After all, in fact, it tends to overlap pretty significantly. The difference is that on this IPO in biotech, these IPOs, they have either stayed flat or they have outperformed the market very well. So in a way, it has been a very safe way for investors to join the biotech market, as opposed to the typical binary risk that a more mature company represents. Despite these numbers, I find that the trend which is more meaningful to me, when I saw it, and I made a point not to forget it, is looking at the value, at the pre-money valuation on some of these deals. So you can see that it has increased from about 150 in 2012 to 350, close to 400 at present. Now that is the median valuation pre-money before these offerings. That is a very good trend line. I don't think the quality of the companies has changed that much. There are things that we are better at. There are new technologies. The FDA is cutting more slack, and we can discuss those and their impact on the market. However, companies have just become better at presenting themselves and at being built in the first place. Now, when you break down the trend in valuation from 150 to 350, the 2 or 3x that it has taken, the most significant component is that if you look at the quartiles, the top quartile of that valuation in the last few years has stayed flat, whereas the bottom quartile has actually joined and moved with the median up. So I don't think it's a question of worse biotech companies are just not entering the public market. I mean, that does not make any sense. There are terrible companies out there every day that I see. But they have become exceptional at the pitch, at the template. And this is one theme that I wanted to reinforce here today because it takes a new meaning as you cross the Atlantic. What that message would be is that the VCs out of Boston, San Francisco, some in New York and down south, have become experts at packaging a biotech company. And we see that in the flurry of IPOs this year at the large fraction which are preclinical IPOs. This had never happened before. And if we had spoken about preclinical IPOs maybe 3 or 4 years ago, everybody would laugh. And yet we are seeing them fetching valuations that are at par with the clinical stage biotechs. So the packaging has become incredibly astute and sophisticated. And when added to the FDA leniency, thanks to the new commissioner and some trends that have been going on for 2 to 3 years. And in addition to the new technologies that have entered the market, gene editing, immuno-oncology, et cetera, this has had its effect. Now, the message in that is that there is then room for companies coming from outside of that paradigm that are able to put themselves in the template that seems to be preferred by US investors. So, in other words, to sort of compete with the likes of the Boston companies, it is achievable. It's a matter of, having grown up, like myself, in the streets in Europe, whether you then are able to go to Harvard and then fit in. And I believe that's all it takes these days to then achieve that valuation. So I'll stop there, and then, perhaps later we can also get into the details of that optics.
Okay, excellent. I think that you were already raising some very interesting topics, and we will certainly address them, or some of them, in the next minutes. So, Susanna, I would like you to see what's the view of Euronext on this same period where we have seen this so active market in both parts of the Atlantic, and to what extent. What are the different nuances from the European market, like Euronext?
Yeah. I will use a presentation to give some numbers.
Please do so.
And to introduce Euronext, so everybody understand who we are and what we do, and our presence within the life science sector. So basically, we are the first stock exchange in Europe and number 5 globally. And in terms of life science, we have 89 life science companies listed on our markets, so quite a lot, with 23 market capitalization in aggregate. And that's the result of having like 500 active institutional investors that know the market and are very active in this segment of life science, which is quite particular compared to others. So basically, we are the world leading market for medtech, and only the second behind US in the case of biotech companies. And as you can see here, this is a split of the companies that we have listed in our markets. We have a quite variety, so we have a lot of small companies. So I guess this is quite relevant for Spanish biotechs and life science. So in Spain, it's difficult to find companies above 500 million, so we still have some of those, but there are a lot of smaller companies, and that means that we have investors that are willing to invest in this type of companies. So I think that's relevant, especially for the Spanish community. And here we have, these are the companies that we have listed on our market. Some of them for sure will be familiar for you. We have the very large one, Galapagos. We had, well, Digenix is still here. It shouldn't be here anymore, unfortunately. But we have, as you can see, within the different sizes, we have a wide range of companies operating in both in biotech and medtech. So looking at the last 5 years, as Jotin was saying, we in our case, what we have seen, it's a big, well, we had 2013 was really, we had maybe a decrease, low number of listings, and then this started to grow up in 2014, 15. In terms of new listings, and in 2016, 17, it has been relatively stable. But if we look at the secondary deals, which are very important for us, and is where really life science companies really can see the differential value of being listed, because it's very easy for them to have access to new money when they need to raise additional funds. We have seen a growing trend over the last 4 or 5 years, and so last year, companies listed on Euronext markets, 39 of them raised more than 1 billion euros, and this year, 19 companies have raised almost $500 million. So in terms of, so it's, of course, Europe is not only Euronext, so we have other markets. Of course, as we can see here, Euronext has the leading position as of today in terms of aggregated market cap of life science companies, and it's followed by the Nasdaq Nordics and then the London Stock Exchange. And then if we look at in terms of capital raised over the last few years, we can see a similar chart with Euronext as the leading market, both in terms of primary funds and secondary funds, and followed in this case by the London Stock Exchange and then Nasdaq as the third one in terms of money raised by companies listed there in the last 5 years. So here are, well, just a few examples of companies that have come to the market. In general, we have seen small, medium-sized companies being able to access the market, and then a lot of follow-ons with companies that have raised 70 million, more than 100 million. So we have a lot of different sizes of companies. And in terms of liquidity, as we can see, we have pretty nice figures in terms of liquidity. And it's important to see that also for small companies, we have very good figures, the best among the other players, but also for the large ones. So we are, as we have a critical mass in Europe, we are able to get investors interested in investing in different sizes of companies. So even the smallest one that maybe for them is more difficult to access the US market, they can find in Euronext a very good way to finance their growth and to have visibility, and also to access US investors, because as we can see here in our case, especially for, this is specifically for life science, 49% of our institutional investors come from the US. So at the end of the day, I think the message is that European companies do not necessarily need to go to the US to have access to US investors, as US investors are coming to the European markets to look for European biotechs. And I think there is a lot of value on that. Well, I don't think we need to do that. Well, apart from that, I think other useful things for companies that we have on Euronext are a specialized index, and index help companies to have more visibility and increase the liquidity and also the perception and the perceived quality of the company. We have one for tech companies and another one for biotechs, and it has had a very good performance also over the last 5 years, outperforming the Euro stock and the CAC 40 and so on. And well, that's we also have other initiatives like we have an agreement with Morningstar to cover all the tech companies, so including the life science, and having an analyst covering the stocks is very important. I think in average we have every company listed on our market on tech has like 2 or 3 analysts at least covering the stock, and I think that's important because maybe if they go to a larger market, analysts are not so interested in covering small companies. This is the split of the index, and then we have some intelligence that we produce on a recurrent manner. We have the biotech barometer. We produce it twice a year, and we analyze the performance of the companies listed on our markets. And the last one, which was published in July, shows that in fact there is a current there is some volatility in the market over the first half of 2018. I think this is the result of a lot of deals in 2017, a lot of small medium companies entering, especially the French market. So we have seen very different evolution of our 3 main markets, so basically Paris, Amsterdam, and Brussels. So in Belgium, we have had an amazing performance, and that has been boosted by M&A transactions, such as the one of Tygenix, and we have had a great performance there. On the other hand, French biotechs suffer some underperformance for no specific reasons, but sometimes if companies have some miss some dates or some results, investors are reacting. So I think that's what we have seen is that this is a general trend. So there are some IPOs in the European market or in Euronext that have been postponed in 2018, because I think that investors are cautious. So given the macro trend situation, but we believe that it's only something that those deals will be taken over in a few months, either before the end of the year or beginning of 2019. So well, that's basically all as a way of introduction.
Thank you, Susana. Claudia, I would like you to start these first remarks with some of some of the details that you can share with us about your journey on this dual way that you were starting by this reverse merger, which was a very smart transaction, I would say, and getting public there in the Euronext, and then the dual listing. How you could summarize all this for the audience?
Okay, so I think we have here the two, I would say the two sides of the moon that we have just seen. So on one side, we have the analyst, which is definitely an important piece that we were looking at. When we reverse merged in 2011 with Tygenix, being in a very niche technology at that point with phase 2 data and phase 3 coming much later on. One of the challenges at that point was definitely talking with analysts and revamp the story of the company, because remember in 2011 we basically had our core technology coming from Spain, from a private company which had been then funded by VC, so completely private. And so we reversed into an existing entity, which was already a public company. So this is actually one thing that I wanted to comment, that Susanna was commenting as well. Euronext is extremely friendly in terms of finding vehicles and reverse merge. So that's another route that perhaps it's a little bit more streamlined than going for a pure IPO, which implies an extensive, preparation, legal and documentation aspect, which is also relevant. It's an exhausting journey, and I can comment also on Nasdaq, which we also did later on. So my point is that you have to have your analyst, you have to have your market and investor ready. And we actually came to Euronext with that, let's say, work partially done. And the journey started precisely when we finalized the reverse merge in 2011. So back in May, what we did at that point was to kind of have, a revamp of the story and explain the rationale of the reverse merge, both for the private investors and for the public investor, which had been on the stock since 2007, so quite a long time, with ups and downs, but mostly down. So what my point of caution here is, once you are public, obviously the game changes and the market is open for accelerated book building structure, so for capital raise, which are pretty quick to be done, different from a private setting. So the benefit of raising capital very quick, you have also your analyst explaining what's the technology about and the target price, so everything becomes much easier. However, there has still a lot of work that need to be done, and we actually started after the reverse merger in 2011, and we went up to 7 analysts, I think, in 2 years' time. So our goal on the IR side was precisely to increase the analyst coverage and have as much as a non-deal roadshow as possible to prepare for the catalyst which would come later in 2015, which was the result of the phase 3. So I think it's important that companies and CFOs and the CEO prepares for that journey as well, and takes all the time, not only on the business and the operation, because daily business need to be managed as well, but also on the IR side. So that would be my little grain of experience for Euronext. And then we can discuss on Nasdaq later.
Okay, Jotin, you were giving us a glimpse of the situation on the markets in the US. Still, I would like to ask you if you could have a magic glass ball. I mean, we have seen a market which is incredibly dynamic, and it's definitely a buying market. So, we have been discussing previously that, I mean, to some extent, everybody's thinking what's going to happen next, because it's true that the figures of the American economy are so good on the short term that everybody foresees a continuation of the market strength. Still, what would be under your eyes the risk or the concerns that may arise on the next quarters? And to what extent do you think that this valuation that you were saying that are being, I mean, some of them quite flat and quite stable, but some of them you were mentioning that they were rising. So to some extent, how these particular movements can suffer from a change on the market spirit?
So I was trying to avoid answering that question from my initial comment, and I knew that you were coming back with it, and I was hoping you wouldn't, for the simple purpose that, if anybody starts telling you about their opinion on the trend on the market, on the macro in the US, I think that is the cue that you should stop listening to them. The reason for that is primarily because in the last 2 years, since the last administration, we have been completely unable to predict which way the market is going. That is, the market has been performing very well, and so have companies, and so has biotech. However, about 2 or 3 times a year, we have been bracing for impact, and it just has never come. So in a way, the market, specifically equities, have become completely dissociated from the political show business. I think there has been some desensitization going on there, and everybody is enjoying that. Biotech is certainly overreacting to that, even though there are other support mechanisms that have propelled biotech. Now, going into the future, and this is the question, this is something that we discuss almost daily with some of the investors that we communicate with, as well as with the companies that are thinking of listing. It has been very good times. The biotech index has performed exceptionally well. The macro environment, there is a general consensus that it would take something external to potentially reverse the course, the good times that are going on right now. Not because we do not expect internal issues. There may be some coming with the elections that are ongoing right now. There may be more in terms of, following the election, political scandal, etc. You never know what happens in the US, especially these days with Twitter and everything. However, the consensus is that the market has been desensitized to internal stimuli or offenses, and it would take something external. Now, when it comes to that, the administration has also not disappointed. There has been, Korea and Russia, etc., and now it's China, which is different because the previous were political crises. This is an economic one. However, again, the approach on Wall Street has been that, to just disregard these. So my outlook has been positive on just the general macro in the market, just the equities in general, but somewhat cautious on biotech specifically. And that is for reasons, somewhat related to the political system, because biotech always overreacts. It's the first that investors drops. And more to do with just the valuations and how they have moved in the last 2 years. It is, and I'm very data-driven, and we should all be, given the industry that we're in, right? We use science and medicine and data to advance human integrity. So the valuations, as you explore them, not just the public valuations, but also just something simple, the numbers like the Series A investment in the US, they have become completely dissociated with the actual value of the process of developing drugs. And so then, coupled to the trend line of, the biotech index now having reached the same high as it was in 2015 before the correction, that makes me nervous. So generally, I'm very positive and optimistic on the market, not because of a fundamental strength, but because of our inability to actually correlate it to the political system in the US. And in the meanwhile, I'm somewhat cautious on biotech in the next year. Now, the question becomes, when do things happen? And I have no idea. However, every year when this talk starts happening, and I think Claudia probably has been exposed and is immune to this, the general sentiment in New York, in Boston, is that we should be safe through the next JP Morgan. And it's sometimes a self-fulfilling prophecy, but through January, everyone expects the good times in biotech to continue. And after that, we'll reassess. Yeah.
Okay, so point taken, there is a clear disconnect between the political world and the markets, and there is some issues on the valuations. If we have time to comment later on the difference between the Hong Kong markets and the Nasdaq market, we can go on these topics. But I would like to, just to finalize this sort of macro view, I would like also to ask Susanna and Claudia, I mean, what might be the macro risk in Europe for Euronext in terms of the Brexit storm that we are seeing that is growing over by the day, and Claudia, I mean, advancing your I mean, one of the questions that I wanted to ask you by the end about your new responsibilities in venture capital. What is your perception of the macro risk for the private VC? So, Susanna, please.
Yeah. Well, I don't know if it works. It works. Yeah. So in terms of macro environment, basically, well, it's difficult to predict, and I think basically now everything is interconnected. So we are in a global market. So basically, I agree with what Jotin said. So it's difficult to predict, but probably what happens in the US will also have an impact in Europe. If we go to the Brexit, well, still we don't know what will be the final result of the Brexit. But on our side, we believe it's an opportunity for the continental European markets and also the Irish market. We have recently acquired the Irish Stock Exchange, so Dublin Stock Exchange is also part of Euronext, and in this market, normally most of the companies that are listed are dual listed in London. So we believe that probably most or more companies listed in London, we will dual list as well on Dublin. So in order to be part of Europe as well. So and probably some companies, so that's from the Euronext perspective, some companies that may consider doing a listing on the London Stock Exchange will come to Euronext, and probably some UK companies as well will come to Euronext because they will have a stronger community being part of a European platform. And we have had one example of Acacia Pharma. It's a UK company that did an IPO in Brussels earlier this year. So we have seen already some interest in our markets. So I think we should take advantage of that. Yeah.
Okay, so it's obviously an interesting question. I have to say that I just lately joined, and I think with ESIOS, what clearly we see that there is an interesting spot, and that spot is company that has incredible new technologies that can make a difference, and I think that was very much what Intelligenics made us interesting for Takeda later on to be acquired. So I think it's a combination of the management and the technology and the data that you have, and be ready for discussing with your potential partner well beyond the simple licensing. So that those kind of opportunities are extremely interesting, not only on the let's say private side, but also on the public side. And what I refer to this is when we were IPO, and that point it was a tweet by Hillary Clinton about pricing, and that bumped completely the market. We were just preparing, and then everybody was so shy about pricing in pharma that we had to kind of fine-tune and stop. So we have to live on a market independently of where the political side is, that is very fluid and always changing. So you need to be prepared that indeed that window, I've never seen a window, always seen a crack. So you really have to be, ready to go. So technologies that are innovative, disruptive, and create new approach for treating patients. Like in our case, it was a cell-based approach, which definitely was an interesting area for Takeda, which the CMO and CSO and the plumber just indicated that is one of the area, both in oncology and and in cell therapy like the one that we have, or anti-inflammatory, are definitely extremely interested to foster and keep growing. So I think microenvironment is always there. So you need to prepare your strategy based on milestone and based on being ready when the market opens, which means have done your homework pretty much in advance. It's an exhausting exercise, and that is expensive, but I think it pays off at the end. So in our case, it definitely was a thrilling adventure, but with the support of of the investors, and with this continuous talk about what is coming and what you're doing, I think it really pays off.
Well, with this, I think we can stop the macro, and we can just land on the specifics of the small companies, and then I would like to open this part of the discussion today with the U.S. versus European. So we are Europeans, and we always have a certain I wouldn't say complex, but we feel shy when we are comparing ourselves with our American fellows. So I would be very interested on jotting what's the optics from the U.S. investor side for a European company. What would make a European company palatable for a U.S. investors? And yeah, what can be the differential trend that European biotech should really work on this pitching for attracting the investors' attention?
Yep. So that's a 2-hour answer. Okay, yeah, 2 minutes. Yeah. Here, well, let me. Before, when I spoke earlier, I said that there's been a change in how companies are being packaged in the U.S. So let me continue there, because I think that is the key to breaching the market or entering the market. The evolution of there's been an evolution of these companies that are now IPOing, or at least testing the waters. And it is not the classic Darwinian evolution that we know. It's fairly Lamarckian, right? Lamarck came up with a theory that, if you're a giraffe and how did you end up with a long neck? And Lamarck was, very clever but very wrong. He said that, you are trying to get the high leaves, and so your neck stretches over generations. We now know that's not how it works. You have a long neck and you survive. That is a grim view. However, Lamarck was right when it comes to the biotech market in 2018. These companies are surviving and IPOing in a Lamarckian way. What are the properties now that our friends in the Boston VC world have become very good at packaging and are appealing to an analyst? And also you try to find in a European company, and sometimes you find, let's say, 2 of the 4 or 3 of the 5, but never all of them. I'd say there's about 4 or 5. One, and they go along some of the things that Claudia mentioned. One is fundamental science, so a good scientific base for the therapeutic proposition. Not necessarily a recycled asset, not something that was put together, even though they are fetching very good valuations these days as well. So fundamental science. 2 is a pipeline. So there needs to be a pipeline. If there isn't one, you need to create one by in-licensing. In the absence of a pipeline, there needs to be a platform. So if it is a single asset which is going into phase 1, then there needs to be the possibility of new assets being sprung out in-house. Number 3 is a team in place. So no such thing as a CEO and a CFO and then hire everybody else once the money is raised. That will not fly. A team in place where everybody has a very specific role and covers some of the intricacies in the US market. So specifically, there needs to be somebody who actually understands and can react to the FDA. I mean, that is a position that is required almost in every US biotech. Given the flux at the FDA recently. So a good team in place. And then lastly, I say this last, but it could as well come first, it is therapeutic area. There is always ones that are fashionable and hot, and there are the ones that fall out of favor. Now here, you can exercise some strategy, certainly, by adding, if you have a pipeline, but typically we all know the ones that are fashionable at any point. You know, there is one which just never goes out of fashion, and it's oncology. It will never go out of fashion, right? And there are reasons for that, because in the US market, you will have very favorable development times, you have very favorable reimbursement, the commercialization is much easier than other indications, etc. Things that are very appealing to a CEO, but also to an investor. Oncology is one of them. Other areas go in and out of fashion in a sinusoidal way, like gene therapy, for example. You know, you all remember when we were talking about it 10 years ago, fell out of favor, it's back again. And there are new areas, like, for example, immuno-oncology, or, NASH, the fatty liver disease, etc., that have just entered. So being in one of the areas that are fashionable right now is sort of the ultimate component that you have perhaps less control over. But otherwise, there is these 4 properties. And as I said, you find them in all of the companies that are being packaged or chaperoned out of San Francisco and Boston. And I find them in very few European companies that are trying to breach the US market.
I think this is very, indeed very didactic for our attendance today. Claudia, I mean, you were doing a dual listing, so you were transitioning from Euronext to Nasdaq. And you were doing so after 2 trials. So I would like to the extent that you can share with the audience, I mean, what were the reasons to make this step once you were already public in Euronext, which is a very powerful market, as we have seen, and what was not working the first time, and what was, working on the second time. So what were the differences? There was just environmental differences on the market. There was some differential approach for one attempt to the second. So
I was trying to organize my thought, and I think it's like this advertising that says, when you go Nasdaq, be mindful. This is only for professionals. Don't do it if you are not a stuntman, if you are not, someone who can raise at least 3 times after failing. So you need to be prepared. It's, as we just mentioned, it's a very sophisticated market, and you are facing the competition of companies which have been raised in the mindset of getting public, and which, as we just mentioned, are kind of thinking, in a completely different mindset, which is packing and packaging and doing it in the right time, with the right way, with the 4 magic elements which you just mentioned. So when you get there, the first reaction that you have is really, let's go back and do our homework extensively. I was back in 2015, and we were already in Euronext, but indeed Nasdaq, because for a European company which is preparing for an IPO in Nasdaq, is actually seen as a first-time IPO. So you are not actually on a follow-on structure. You are with your documentation as an IPO, you prepare your IPO. Valuation in Europe, unfortunately, we have seen is not as great as in the US. That's the only thing that they look at. The rest is completely, new, from scratch. So our experience was very, in the beginning, difficult. One of the things is that when you are a US IPO and you start that track, you already have quite a significant insider participation of US crossover investors, and we all know them, and actually they were all on those lists. So I think one of the necessary homework for European company, if they want to cross the pond and go there, is really do some private round which cross to the IPO over. So which means, investor like OrbiMed or RA Capital or Deerfield or any of, BlackRock, you name, you have them all. And be as brave as possible with the bankers to go there and pitch to them. So most of the time, as I said, it's training and educational experience. You prepare for first non-deal roadshow, you come back, bruised up completely, you polish your story, your narrative get better, you go there with additional data, you have increased your IP, you have increased your potential, you have a better understanding of the pricing of your drug, of your indication. So I think it's a continuous effort, and that is something that, by the way, is done by the full management team, not only by the CEO and the CFO and the IR person. It's done by the CMO, by the CTO, by the IP director. It's a continuous effort. So I think our experience was definitely, long walking across in the desert in the beginning, but really paid off. Though I have to say that, you have all the pain, and so get ready for the gain when it comes, but definitely be prepared for the pain. But I think it's worth doing it at the end, because you, as I said before, you are facing, kind of the champion leagues of the company when you go out.
So on your view, the crossover investors and the inside traction is key, I guess?
I think so, yeah. I think it is key. And I think that structuring your investor bases with specialized institutional investors ahead of the IPO, which, I mean, it's not magic things. It's mostly all US companies grow themselves through different series up to, D, E, and G, or whatever comes, with investors that, as we were mentioning, are already thinking on how to get to the IPO. So I think in Europe we are actually very much on this same path. So investors, institutional investors, VC and funds are syndicating with US crossover investor for company which need to go to Nasdaq. And because when you do the book building, at the end you have to have some key participation, and for an IPO of a 50 million, 60 million US dollar, you have to have somehow your anchor investors, as you say, well-defined and structured from the very beginning. So having investor which can also hold their shares after the lock-up period, and most of these, like Wellington, like pension funds. So you structure your book in a way that you can, keep going and create liquidity after the IPO. Because what you also need is hedge funds which create liquidity in the short term, but some kind of holding stock, holding people like pension funds that are more for when the milestone will come. So I think it is, kind of with the bankers, an exercise of, structuring the basis of your shareholder before the IPO, in the book building exercise, and in 12, 18 months after the IPO.
In terms of adding to that, in terms of evaluating your readiness for testing the U.S. market, maybe not even IPOing, there are mechanisms now, sort of evolution in the regulation and how things are treated, that make it very favorable to just assay whether you are ready. So there's the whole new concept of emerging growth companies, which we didn't really have before. So that is a key advantage, and I usually list it as one of the, not advantages, but one of the bonuses that come with exploring the US market, is this treatment as an emerging growth company. And what it is there is a very clean definition of it. And typically, if you are wondering if you're an emerging growth company, that means you are. Because if you are not, then you probably are not left wondering that. But it is, revenues of over $1 billion, I think a market float of 700 or something like that. It is a specific definition. Now, what it means is that you are able to file confidentially with the SEC and receive feedback, and then potentially just pull it or delay it without any optical liability. Now that is very important, because I've seen companies withdraw their filings and then it just never goes well from there. So with the emerging growth regulation, that is something new and very helpful in the US market. And it plays to the European advantage, because you are able to have testing the waters meetings, right, the formal term, which you cannot pitch an offer, right? You cannot actually go in and make an offer for, stock issuance. That would be illegal. But you can have the meetings with investors, whole days of them, and make your pitch, present your company, your pipeline, etc., get feedback from them. And in that kind of meeting, I can say sort of 90, 100% certainty, you then get a sense whether they would want to invest in you or not. So, all of these dynamics around being an emerging growth company are a big bonus and you know, should be leveraged by the Europeans. Yeah.
No, I agree, definitely. We actually used the concept of test the water meetings and flipped while we were confidentially filed into a private placement. So provided you're not publicly filed, you can still, with some limitation, and there are some legal restrictions that need to be checked with the US lawyers, but you can finally see if the market, the book is not there, if the size of the interest is not sufficient for go for a full IPO or the valuation is not there. You can still, you know, work and use and capitalize the test the water meeting for a potential final private round with US investors that can finally go for the IPO in Nasdaq. And the same actually applies for Europe. So I think it's a very convenient, a convenient structure, and it should be used extensively before you go public, definitely.
We are getting close to the hard stop. So I would like to open, the questions to the audience. If there is any, yes, Joel, can we give them a microphone, please?
Hello. Yeah, Jean-Marie, Isios Capital. Very interesting panel. I have a question, one for Jotin and the other one for Susanna. You mentioned earlier on, you know, sexy spaces, immuno-oncology, gene therapy, and preclinical companies going out and floating. And then you also talked about the top quartile in the 350 and 150. Is there any correlation between the classical stage of development of a company where you know, the company has certain risk profile with phase 2, use of proceeds are clear, it has a pipeline, versus, you know, this new sexy, or even senescence, aging, Unity went public also with, you know, a blue sky story. So are these companies on the top quartile, or how does the market, you know, or investors look at this?
What we have seen in the case of Euronext, at least, we don't, I think investors are still very focused on low risk, you know, the lower risk as possible. So, so I could say that companies need to be in phase 2 or phase 2A, phase 2B ideally. So I don't think investors are really willing to really push and invest in companies with very early stage development. That's what we have seen, and especially maybe in the last 2-3 years, 2016 and 2017, we have seen some examples of companies with accessing the market at an early stage and with so-so development. So based on that, now investors are a bit more cautious. So I think they are very focused on quality assets with strong developments and a pipeline, as Jotin was saying.
The number of the preclinical crossovers and IPOs has increased in the last 2 years, as you know. Before they were there, they did not, you know, match up to the clinical ones. Now, is there a fundamental difference between those and the clinical IPOs? Frankly, I've looked and I don't really find one. It is really the same indications, more or less. It can be new technologies, but so do the clinical ones. So, you know, there's no real fundamental difference. The one thing that they have in common, and you know, I don't mean to be sarcastic on this, is that it's the same VCs behind them. And so, you know, what that says to me is that they are pushing out everything they have. Which you could interpret with caution then. However, in terms of the valuation for these, and what that would mean for the European companies, because in the end, you know, that's why we're sitting here, is I look at the earlier rounds, right? What is preclinical out there? And so if you look at the earlier Series A, let's say, or Series B, that has been an upward trend in the numbers, right? In 2017, there was about 3 billion Series A collectively for biotech. And a large proportion of that was 1 or 2 companies. But still, the remainder, and how much of that went to each company, in Series A, it was, 80, 100 million. That was, we'd never heard of before. In 2018, this year as well, just in terms of the data, it was about that in the first half of the year. Just Series A. Again, driven by 1 or 2 big deals, but then the rest. Now, what that says to me for the Europeans is that all of these were preclinical. These were platform plays. They had nothing, right? And yet, the valuation, the pre-money was appropriate. They were not raising 100 million on a 20 million. It was so. What that says to me is that this march onward that they have started from their U.S. investors, which are expecting them to IPO in the next year or 2, which would have been crazy, insane 2 years ago, that march is going to break down pretty soon, I think. Even without the market being perturbed, because they will just not be able to keep up with the development staging, even with all the leniencies that Scott Gottlieb is giving companies. And what that says to me is that will be then an entry point for European companies. Because, yeah, we have these platform plays and preclinical that are being valued at this, magical valuations. It's like the term in psychiatry, we have that in magical thinking. However, soon enough, there will be buyer's remorse there. And then, now I don't think that US investors will seek companies that are clinical with the right asset, etc. But where that will come from, I think that will come from Europe. Because there is plenty of companies here that are clinical. They have the right elements. They just don't have the optics or the access. And their valuations have a significant delta. Down, right? And so that will suddenly be there when some of this preclinical platform early seed march comes to a halt. Yeah.
If I can just add one follow-up question for Susanna. On the European platform, so Paris, Amsterdam, Brussels, how important is it to be close to those cities? I mean, I'm talking, for example, a Spanish company wants to float in either of these 3 markets or these 3 stock exchanges. How important is it to be close to those cities? I'm talking about cities per se, and that's question number 1. And question number 2 is, are there differences in the retail market in each of these, Brussels, Amsterdam, Paris?
In terms of proximity, I don't think it's not that relevant that you are close to the cities, I would say. So if you're a Spanish company, you could target Amsterdam, but in the case of life science, the bulk of companies are in Paris and Brussels, I would say. So are the main 2 cities for life science. And of course, what companies need to do is to go frequently to the cities to meet investors, to meet advisors. In these 2 cities, in Paris and Brussels, there are a lot of banks, boutiques that organize events with investors. So it's important that the CEO and CFO of the companies that are listed there go and meet investors, new investors, so they promote liquidity. So I think it's important to visit those cities frequently, and maybe you can go to Brussels even if you're listed in Paris, because at the end of the day, our markets are connected, so the different markets are part of the same platform. So if you're listed in Paris, you will have access to all the investors that are working on operating in Brussels. So that's not a big difference. But in Brussels, there is a big community of life science, and then Digenix was an example of that. And the second question was. Yeah. Regarding retail, I would say that in the case of retail, Paris is the most developed one, but Brussels as well, it's developing well. So I think that's something to be considered, depending also on the type of company and how the public can perceive it, also depending on the therapeutic area. But I could say that the most developed one is Paris, is France, based on the experience also in the number of companies that have a retail tranche. But in Brussels, it has been working well as well.
Okay, I think that we have come to the end of this time. So I would like to thank you all for sharing with us today your views. I think that we have been covering some very interesting angles from the macro to the micro views, from the European markets to the US markets, examples of live samples of real examples of European companies becoming US companies. So with all this, I would like to thank you all for joining us this morning, and thank you very much to everybody.